You've probably seen them, those scary headlines that pop up online, right? Stop contributing to your 401k or your 401k is a trap. And, while most of that is just clickbait, there are actually some very real, very smart reasons why you might want to pause your contributions, or at least think about sending that money somewhere else. And look, this isn't about scaring you. Not at all. This is about being smart. It's about strategy. Okay, let's dive into this.
First things first, let's be absolutely crystal clear. The 401k is one of the most powerful tools ever created for building wealth for retirement. I mean, just look at the data from Fidelity, which handles millions of these accounts. They found that the 401k has made more Americans millionaires than any other kind of account out there. We're talking over 400,000 people who are 401k millionaires. So let's get that straight right off the bat. The 401k is not the bad guy here. It's all about knowing when and how to use it in the smartest way possible.
So the question we're tackling today isn't some black and white, is the 401k good or bad? No, it's a much more personal, much smarter question. And it's this: based on your unique situation, your income, how much you've already saved, what your goals are, where is the absolute best place for your next dollar of savings to go? The whole point is to be intentional with your money, not just to save on autopilot.
So here's how we're going to break it all down. We'll start with a surprising problem that really good savers can run into. Then we'll look at the huge role your tax bracket plays. We'll talk about planning for real-life situations, what to do when your 401k plan itself is the issue, and finally, we'll wrap it all up with a really powerful three-bucket strategy. Okay, let's dive into our first big idea. And this one, well, it might surprise you. This is really for those of you who have been doing everything right for years, the diligent savers. If you've managed to build up a really large balance in your traditional tax-deferred 401k, you might have accidentally created a big tax problem for your future self.
And this whole problem is created by something called a required minimum distribution, or as you'll often hear it called, an RMD. It's pretty simple, really. It's a government rule that says once you hit age 73, you have to start taking money out of your traditional retirement accounts. And here's the kicker: you don't have a choice. And every single dollar the government forces you to take out is counted as taxable income for that year.
Right, and this is where things can get a little tricky, where this snowball effect really kicks in. See, even after you start taking money out, your account is hopefully still growing, but the RMD amount is calculated based on your total account balance. So if your account gets bigger, your forced withdrawal for the next year gets bigger too. And this can create a cycle where your taxable income, and therefore your tax bill, just gets bigger and bigger every single year you're in retirement.
And this chart, wow, it really paints a picture of the problem, doesn't it? That RMD income isn't just floating out there by itself. It gets stacked right on top of any other taxable income you have, like your Social Security benefits or a pension. And for a lot of people who did a great job saving, all that income stacked together can easily push them into a higher tax bracket in retirement than they were even in during their peak working years. It's the complete opposite of what most of us plan for.
Okay, so that whole RMD issue leads us perfectly into our second big topic, which is the really fundamental choice you have to make about when you want to pay your taxes. It all comes down to your tax bracket, your bracket today versus what you think it'll be down the road.
So at the heart of this is the big difference between a traditional 401k and a Roth 401k. With a traditional 401k, you put in money before taxes are taken out. This is great because it lowers your tax bill today. The catch? You have to pay income taxes on every penny you pull out in retirement. A Roth 401k is the exact opposite. You pay the taxes on your contributions today from your regular paycheck, but then all of your qualified withdrawals in retirement are 100% tax-free. It's that classic choice: pay the taxes now or pay them later.
So what does this all boil down to? It's really one simple question you have to ask yourself. Do I think my tax rate will be higher in the future, or will it be lower? If you expect your income to keep growing throughout your career, or if you're one of those super savers we just talked about who's facing potentially massive RMDs, well, there's a very real chance your tax rate could be higher later on.
I mean, just think about how a career usually works, right? Maybe you start out making $60,000 a year, but 20 years later, after promotions and raises, you could be making $140,000. If you contribute to a Roth early on, you pay your taxes when you're in those lower brackets, like the 12% or 22% bracket. Then you get to enjoy all that growth and take all that money out completely tax-free later, when you might be in a much higher 24% bracket or even more.
All right, let's pivot a little bit. We've been talking a lot about taxes, but sometimes life gets in the way, and your financial plan needs to account for real life. There are definitely times when having financial stability and access to your money today is more important than locking every last dollar away for the next 30 years.
But hold on.
before we go one step further, I have to be absolutely 100% clear about something. This is the golden rule, folks. You always contribute enough to your 401k to get the full employer match. I don't care if it's a 50-cent match or a dollar-for-dollar match. That is free money. It is the best guaranteed return on an investment you will ever find, period. So that part is totally non-negotiable. Everything else we're talking about today only applies after you've secured that match.
Okay, so you've secured that free money from the match. Fantastic. Now what? Well, this is where your priorities might need a little shuffle. Before you just automatically max out that 401k, it might be a whole lot smarter to build up a solid emergency fund first, or attack that high-interest credit card debt. Or if you have access to one, fund a health savings account, an HSA. Building that stability today is what protects your long-term plan for tomorrow.
And this idea of flexibility is absolutely critical if you have any dreams of retiring early. Think about it. Your 401k money is generally locked up tight until you're 59 and a half. So if you want to retire at 55, how are you going to pay the bills for those 4.5 years? Well, this is where a regular taxable brokerage account becomes an essential tool. There are no age rules. You can take out what you originally put in anytime tax-free, and the growth on your investments gets taxed at the much friendlier long-term capital gains rate. It is the perfect bridge to get you to your official retirement account.
All right. So far, everything we've talked about has been about your personal situation. But what if the problem isn't you? What if the problem is your 401k plan itself? You see, some plans are fantastic, but others are loaded with high fees that can just silently eat away at your returns year after year.
You might be thinking, a 1% fee? That doesn't sound like much, but you have to see what that does over time. Over a full career, paying just 1% extra in fees can slash your final retirement balance by 20 to 30%. That is a massive, life-changing amount of money. High fees don't just cost you a little today, they rob you of decades of future growth that money would have earned.
And take a look at this. This data really tells the story. Your fees often come down to how big your company is. Big companies have the power to negotiate really low fees. But if you work for a small business, say with under 100 employees, there's a much higher chance you're in a high-cost plan. We're talking fees that can be over 1.5%, even 1.75% per year, and that's where it really starts to hurt.
So when you get your plan documents out, what exactly are you looking for? Here are the usual suspects, the things you really need to keep an eye on. Look at the expense ratios for the funds you're in. Anything pushing 1% is getting pretty high. Watch out for administrative or record-keeping fees that are based on your assets, meaning they take a percentage of your balance. And be really careful with those fancy managed account options, because they can just add another whole layer of fees on top of everything else.
Okay, we have talked about a lot, haven't we? The RMD tax trap, the whole Roth versus traditional debate, real-life needs, nasty high fees. So how do we pull this all together? Well, it comes down to one simple but incredibly powerful strategy. You see, at the end of the day, the name of the game is flexibility. Because having options, having flexibility with your money and your taxes in retirement, that is a real superpower. It puts you back in the driver's seat of your own financial life, right when it matters most. And this is what that superpower looks like. This is the goal. It's what we call tax diversification. You don't want all your eggs in one tax basket. You want to have money in 3 different buckets. Your first bucket is tax-deferred, like your traditional 401k. Your second bucket is tax-free, like a Roth IRA or Roth 401k. And your third bucket is taxable, like a regular brokerage account. By having all 3, you get to choose which bucket to pull from each year in retirement to control your income and keep your tax bill as low as possible.
So the big takeaway here is this. Saving for retirement can't just be something you set on autopilot and forget about. You have to be an active player in your own financial story. You need to be intentional. And you should always be asking yourself that one simple question: where is the smartest place for my next dollar to go?
Because when you start asking that question, you stop just reacting to scary headlines, and you start building a real plan that's tailored for you and your family. If you found this video helpful, please like the video and subscribe to our YouTube channel, Retirement Finance Explained. We provide simple and clear guidance on retirement, savings, and financial security.